Good evening and welcome to another episode of the Weekly Market Rep. My name is Daniel Ang. Today is April 27th, so we are getting towards the end of April. Something Probably something volatile is going to happen in May, like I have mentioned in the past few weeks. So we are coming towards the end of the month of April. So let's take a look at what happened over the past week and what we can expect in the coming week. Now, of course, before we get into the content itself, I would like to remind you that this presentation is not an offer to buy or sell any kind of securities, be it CFDs or FX, and the trading of any kind of margin products do carry risk. Do understand your own risk profile before you attempt to trade any kind of margin product. And I want to also make sure that you are aware that this event is sponsored by none other than IronFX, a sponsor who has been sponsoring my event for quite some time now. And of course, the opinion which I'm going to share with you will be mine and mine alone. It has got nothing to do with the sponsor. Just be aware that the content I'm going to share with you has not been vetted by any kind of regulatory body. So before we get into the content itself, I just want to check with you if you can see and hear me. And I also want to know if you are able to post your question later on. Let me see. Okay. I'm not able to see my own sharing. Let me see whatever we can see here. Okay, so let me minimize this and let's get to the content itself. Okay, this is the now before we go into the past week activity in terms of economics, I also want to bring this latest breaking news to you. On Tuesday, something major happens between Pakistan and India, and we all know both are nuclear power, and their contested area has always been Kashmir. And there was a terrorist attack on Tuesday in which 26 victims, mostly tourists, uh, were killed in the assault. And out of the 26 tourists, 25 of them are Indian. And immediately India accused Pakistan for the attack, and they have closed their borders, and Pakistan has shut off their airspace, and India has threatened to shut off the river Indus, which supply water into both Pakistan and India. So this is not a good development, and both sides have their military on high alert. So if there's going to be any skirmishes in the coming days, yeah, it could lead to an escalation in the situation over in Kashmir. So we all know that Kashmir has been a lingering problem between Pakistan and India after the separation, and this is a legacy of the British Empire. So we can see that this could potentially flare up into another conflict zone. Not that we do not have any conflict zone currently. We have an ongoing situation in the Middle East in which US and Iran are negotiating. I think the US wants Iran to actually shut down their nuclear weapon, what you call that, uh, program, and want them to shoot all their existing uranium to Russia. I think Iran is not playing ball, and it, on yesterday, okay, I believe during a meeting with Time Magazine, President Trump actually said this. He says that if he cannot get a breakthrough in a negotiation, which is currently ongoing in Oman, okay, between the two countries, he may take the lead to strike Iran nuclear facilities. So this is definitely something that we have to watch, because if there's going to be any flare up in the Middle East, especially against a major oil producer like Iran, then a lot of things can actually go haywire. And of course, the situation in Ukraine itself, we can see that Russia has actually stepped up their attack, especially against their military depot, for example. Okay, the ammunition port, we can see that those has escalated. Ukrainian, on their part, has also hit a major weapon depot in Russia. So we can see that there is no clamp down. There is no uh, lowering of temperature in all these conflict areas. Just be aware that this new issue between Pakistan and India could unravel very, very rapidly, okay, because both sides are now on very high military alert. Now, the other thing that we want to talk about is the upcoming FOMC meeting, which is going to be scheduled on May the 6th to 7th. On the 7th, the Federal Reserve will decide whether or not to cut interest rates, which is what the President Trump wants them to do. But based on the uncertainty surrounding the impact of the tariff war between United States and the rest of the world, in particularly against China, the general feeling is that inflation is going to flare up. So unless data suggests otherwise, it's very difficult for the Federal Reserve to cut interest rate without reigniting inflation. So going into the May window in which the FOMC is going to be scheduled, it is very unlikely that there will be any movements in the interest rate front. So that will put pressure on the Fed chairman, because the Fed chairman now has got into the bad books of President Trump, which has threatened to actually remove him, although legally the president does not have the right to dismiss the Federal Reserve chairman. So again, we will have to watch this, and if Trump actually cannot remove the current chairman, which his term will only expire in May of 2026, then what he could do is to nominate the next probable Fed chairman. And if there is one character that pops up that will likely be the next Federal Reserve chairman, then whatever he says may actually carries a bit of weight, okay? Because by then, the current Fed chairman, Powell, will be like a sitting duck. His voice may not be dominant in a sense. So, there's a lot of things Donald Trump can do to actually affect the credibility of the current Fed chairman. So going into the upcoming FOMC meeting, very little is expected, and but again, we cannot rule out any kind of surprise. Okay, so Powell during remember last week, the week before, in the middle of the week, month itself, the Fed chairman has actually did not mince his word. He says that they are going to sit tight on the interest rates front, pending the data to suggest whether the tariff war that we have seen is going to be showing up in data sets in the coming weeks and months. Okay, this will take some time because the data are still coming in, and we do not know what will be the impact. But by and large, we can see that there is some front running going on in terms of companies stocking up their inventory, knowing that the tariff war is coming. So that means in February, March itself, we already saw the signs of increased piling of goods ahead of the tariff after the Liberation Day, which was April the 3rd. Okay, so as far as the Fed chairman is concerned, he said they are likely to stand pat until the data clearly shows how the US economy is responding to Trump's policy. Trump on his own, he said that he backpedaled a little bit because last week we knew that he has been talking about firing the Fed chairman. He says that he cannot uh, uh, he now says that he has no intention of firing him. So this is, for him is very easy to say, because on the one hand, he says that he wants to fire the Fed chairman, and then the following weeks he claw back his words and say that he has no intention of firing the Fed chairman, and that actually caused a rally on Wall Street itself. And of course, on the front itself, we also knew that he has more or less toned down his rhetoric as far as the tariff on China is concerned. And he has been telling the whole world that he is having some kind of a meeting with China, and the Chinese embassy in Washington has actually backtracked and said that there is no such meeting going on, and they are not exactly talking to each other. And of course, we have the U.S. Treasury Secretary Scott Bessent saying that the tariff war between China and the United States is unsustainable. At some point, they would have to talk. So far, China has not indicated that they are willing to talk. In fact, China has put up a condition to actually come to the negotiation table. China said that they have to remove all unilateral tariff going back to before April the 2nd. Meaning you said before there was this universal tariff and uh, reciprocal tariff being imposed on Liberation Day. So now China said that if you want to talk, you have to go back to before April the 2nd, in which then they were willing to come to the negotiation table. But the latest news as of yesterday is that China has quietly allowed certain goods to not pay the 125% tariff that China has imposed on US goods. So that is maybe China way of telling Trump that they are willing to talk, but they will not come under pressure to talk with the condition that although Trump said that he will substantially reduce the tariff on China from 145%, substantial means if he cut by half, it is still 50, 65%. Then of course the Chinese will not be coming back to the table. Okay, the China said you have to bring it back to zero and then we will talk. Okay, so whether that is going to be the case, we do not know. And then we also knew that certain states led by California has actually sued the president for breaching its authority, okay, for because tariff has always been a domain of Congress, and Trump has unilaterally imposed tariff on countries without the approval from Congress because it actually invoked an emergency law, okay, and this is Trump's way of getting around the restriction imposed on the presidency because we all knew the U.S. Structure is such that there's the legislative arm, there is the administration, and there is also the judiciary. So Trump right now is trying to act very much like a dictator by circumventing the Congress as well as not following the what you call that the legislature. Okay, so this has already prompted 12 of the 50 states to actually sue him for an overreach. So this will take some time to go through the legal process, and it will not mean that Trump is going to slow down anytime soon. But it will be if eventually the judges at the Supreme Court rule against him. So we will have to watch this development, but it will not be an immediate concern for Trump until perhaps in the second half of the year, where the U.S. will go into a election for next year. Next year, June, there will be an election, and a lot of governors are due for re-elections. We will have to see that progress, but it will not be immediate. Okay. Now, as far as the expectation is concerned, we all have to be concerned about the inflation. Now, going into next week on Wednesday, we will be looking at the core personal consumption expenditure, which is the Federal Reserve favorite in the inflation gauge. We know that the other inflation gauge, which is the CPI, now the one that both the markets are interested in, as well as the Federal Reserve is interested is the core, meaning to say that inflation minus food and energy, and then they use that to actually get a smooth out a picture of the state of inflation. We can see from this chart over here, both the CPI and the PCE, which is the personal consumption expenditure, has been coming down steadily since September of 2022. So that is something that is very obvious. But the thing is that as far as the core PCE is concerned, which is the red color line, you can see that it has stopped. Okay, it has stopped falling. In fact, it has been plateauing, and uh, as for the month of March, for example, we can see that that number has been perking up again. So there is the risk that inflation may actually flare up over the next few months because of the tariff war. Well, as far as the CPI is concerned, we can see CPI is still pointing southward. Currently, it's at 2.8%, which is the lowest we have seen in terms of the core CPI number year over year number. So as far as the CPI is concerned, it's showing that inflation is coming down, but the PCE has actually has plateaued, and there are signs that it may be resurging over the next few months. Okay, so we have to watch the this coming week, Wednesday, PCE numbers to have the latest reading on inflation, because that will actually also light a path to the thinking of the Federal Reserve. If the core PCE numbers continue to slide, which it may, then there is excuse for the Federal Reserve to actually start looking at perhaps cutting rates. Okay, there are a couple of questions here. Let me get it. Thank you very much. Now, Kanvi is asking PCE entails both essential and discretionary spending, and core means excluding food and energy spending. Yes. Okay. It will take into everything, including shelter, including uh, all the other essential like transportation, for example. We also that those are all inside the calculation itself. The core means they only minus the food and energy component. That's about all. Okay. Now let's continue. Now, this is the US Treasury note. Now, this is not the yield. This is the actual bond prices. We can see that the bond prices surge uh, in the immediate aftermath of the Liberation Day, which is April the 3rd. Bond prices for the 10-year note, which is a medium-term note, because in the US, they issue different treasuries for different duration. We're starting off with 30 days, for example. Those are the bills. Anything below 1 year, they are called treasury bills. These are the short end of the uh, 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 bond curve, okay? And of course, in the middle, we have 10 years and 20 years, okay? And then, of course, the very long bond, which is 30 years, and those are the long bonds. So the 10 years treasury note has always been the bellwether. Most investors and analysts will be looking at a 10-year note to get a sense of where interest rate is heading. Now, in the run up to Liberation Day, we can see that bond prices has actually surged and then it collapsed. You can see that the top here at 114.11 was actually registered on April the 4th. And in just 1 week, okay, the bond prices crashed to 109.25. Okay, you can see on the 4th to the 11th, okay, just over 1 week, you can see that the bond prices are actually collapsed. So when the bond prices collapse, we can see that the yield has actually shot up. Okay, so when you can see that the yield has shot up, it means the Federal Reserve can only control the short end of the curve. Between the 30 days, 60 days, and 90 days, for example, the Federal Reserve can actually influence those yields by adjusting the Fed fund rate. Okay. However, as far as the longer term bonds are concerned, okay, the 30 years and 10 years, for example, those the Federal Reserve had practically no influence. Okay, so we can see that the yield on the 10 years has actually surged. When you can see that these bond prices collapse in just 1 week, it also means there was a corresponding surge in the yield. Now, when the yield surges, it also means the interest rates will also rise. Okay, so now we can see that the bond prices are beginning to climb back up again, meaning to say that over the last since April 11th, the treasury yield has been gradually coming down as far as the 10 years is concerned. Okay, so when we look into the situation here, we can see that in the past week, the bond prices has been coming down in the first 3 days of the week before it actually surges towards the end of the week. Okay, so we can see over the last 48 hours of trading before the weekend, we can see that bond prices has rallied again, meaning to say that the yield has come off. So that will actually be the case going into the PCE release on Wednesday. So if the number comes out on Wednesday that suggests that inflation is flying again, then there is the possibility we can see a resurgence in the yield. So until that is the case, we will have to watch. Okay. So this is the bond yield curve. Now I have put in the short term, the medium term, and the long term. Here we have 3 months, 10 years, and 30 years bond. Okay. So the yield so far as of Friday's closing, you can see the 3 months is actually quoting above the 10 years, which is this one over here. Okay. So it may not mean very much because since February of 2025, okay, we can see that the yields between the 30 days, the 3 months and the 10 years has been crisscrossing each other. Okay, now it is back down again. So we will have to watch, and it is highly irregular for the 10 years to be enjoying a lower yield compared to the short end to the 3 months. Okay, in the usual relationship, it should look something like this, okay? Where the 30 years, the 10 years, and the 3 months are in this correlation. But when the 10 years goes below the 10 months, you can see that there is a little bit of uncertainty in the marketplace. So this is what we call a yield curve inversion. It is irregular. Okay. So in previous sharing, I've shown you whenever the yield curve inverts and then uninvert, meaning to go back to a regular relationship like this is where the risk of recession will actually increase remarkably. Throughout history, and this relationship about yield curve inversion and uninverting always never fail to produce a recession. The difference will be something within 6 months to 18 months, perhaps we will see a recession. So if this is going to be true, and if this relationship goes back to regular relationship like this, okay, currently is irregular, okay, but if it goes back to regular like this, within 6 months to 18 months, okay, we can see a recession. So that will put at the nearest towards the last quarter of this year to maybe 2026, okay. At any rate, 2026, we will likely see a recession, a full-blown recession in the United States. Okay, so this will actually give us that advance warning. Okay, so as far as the pathway is concerned, let's take a look at these equity markets in relation to the three major equity index. We have the Dow Jones in red, and then we have the S&P in blue, and then the green will be your Nasdaq 100. So except for Monday, in which equities were actually trading lower. The last 4 days of the week itself, we can see that the prices has Wall Street actually rallied. Okay, so 4 days of rally relative to one day of dip at the beginning of the week is actually pointing to perhaps a low bit maybe in place 2 weeks ago. Okay, remember there was a spike low and then followed by a rebound, and that has been the 30 days. No, the announcement of a 90 days pause. That was the beginning of a bottom in on Wall Street, which has so far survived 2 weeks. We have not seen a revisit of the most recent low this week itself. So we only have a couple of days left for the month itself. So if the month of April ends, let's say, for example, not necessarily positive, okay, but if it can claw back most of the losses, it will actually create a condition for next month to actually see perhaps an extension of the rally. Okay, so do watch out this. Okay, and then as far as the other asset class are concerned, we have here the dollar index, which is in green, followed by the US Treasury in purple, and then gold will be in yellow, and crude oil will be in black. You can see that on Monday we have a bit of a mixed bag. Gold traded into an all-time high on Monday itself. Now, if you have been watching the gold prices, the price of gold in the spot market has gone to as high as $3,500 per ounce, but that was not followed through by the other asset class, especially by oil, okay? But you can see there was a bit of a change in sentiment. As far as gold is concerned, the following day on Tuesday, there was very little gain. In fact, it closed with a minor losses relative to Monday's closing. And then on Wednesday, we have a massive decline in gold prices, as much as I believe $200 per ounce from the all-time high to the low on Wednesday. So this create the condition for a top in gold. Remember last week we talked about the possibility of a temporary high in gold, and I think by what we see so far this week, that possibility has been enhanced. Okay, although there was a bit to rebound on Thursday, gold prices continue to close weak, and net basis gold actually close weak. Okay, so as the other market that may also see a change is in the perhaps oil market. Now oil actually went down to 98 odd dollars per barrel before it bounced on Tuesday, and then followed by a deeper correction, decline in midweek itself. Now the market actually closed somewhere in between, but there is a possibility that the low that we saw this past week may actually be a temporary low. Now, as far as the dollar is concerned, the dollar has also seen some kind of a rebound. Okay, so the dollar index has actually hit 98, and then it started to rebound. So we can see that that is a possibility that the dollar may also see a temporary low. Okay, now as far as the treasury is concerned, which is the one in purple, we can see that it has not tell us very much, although earlier on we saw that the bond prices are actually closed the week on a positive note. The last 48 hours of trading has seen the bond prices actually stabilize. Okay, so this is the background of what has been happening uh, in the US markets. Now, the only major economic data that was released this past week was the PMI for the S&P Global. Remember, there are two sets of PMI numbers, and in the coming week, we will be seeing another set, okay? So here we have the S&P Global Purchasing Managers Index showing us that the manufacturing, it is doing a lot better than what the market expected. The market expect this number to go into contraction zone to below 50. It did not actually. It has improved on the March number of 50.2 to close at 50.7. We will have to see whether this number remains true in the next update. Then in the services sector, this is the one that is actually worrisome, because the United States has become more of a service-oriented economy. So the service sector plays a more dominant role compared to manufacturing. So it was 54.4, very, very healthy. Market was expecting a bit of a climb down to 52 point. It came in worse than expected at 51.4, which is not a good development. And then when we look at the composite has actually crashed from 53.4 to 51.2, which is a big drop as far as this brown line is concerned. Now, we have to watch this. If the composite goes below zero, which it has not been for quite some time since the start of the war in Ukraine, we can see that this reading at 51.2, if you look back throughout the whole of 2024, this is a very, very low number. In fact, it's the lowest in the last since January of 2024. So this is definitely not a good development, because the composite index is like it's like an average between the services and manufacturing PMI. So if you look at this number, it does suggest that US economic growth is definitely slowing down. Okay, because purchasing managers are not definitely having a higher capex, meaning that they are not spending because of all this uncertainty surrounding the tariff war. Okay, so this is definitely a harbinger of something bad that is coming. Now, as far as the equity markets are concerned, this is the latest update for the Dow Jones Industrial Average. Now, this week itself, we have very muted response from the Dow. We knew that in the last 48 hours leading towards the end of the week itself, Wall Street has actually put out a very strong performance, and the Dow has been the laggard. Okay, the weakest link right now seems to be the Dow, suggesting that international uh, capital flow is not necessarily flowing into the Dow itself. This could be worrisome because the Dow is like a bellwether, suggesting that international money managers, where are they going to allocate their investments? It does appear that this year, especially since the beginning of the year, we are seeing international money managers allocating less towards the US markets. Okay, we can see that European equities and Asian equities has been outperforming the United States, something that is in exact contrast to what we saw last year. So this is definitely got to do with the return of Trump 2.0. Okay, so less allocation to the Dow. We can see that the market did not have a new high relative to the initial bounce in the 90 days pause. Okay, you can see that the Dow itself hit a low of 36,611, followed by a sharp rebound. This rebound that we see over here is the 90 days bounce. Okay, so now that the market has closed relatively higher for the S&P 500 and the Nasdaq, we do not see the same corresponding spike in prices beyond the initial reaction to the 90 days pause. So this can be very clearly seen, okay, in the S&P 500. Here you can see that the week itself closed much higher than the initial bounce in the 90 days pause in the US tariff. Okay, see, so this is suggesting that retails are coming back in the markets. They are more confident about the equity markets compared to international money managers. Now, this is never a good thing. Remember, the S&P 500 is very much a domestic, very retail-oriented index. So if we can see that the Dow is not leading the pack and is led by the S&P 500, it shows that retail investors are more confident about US equity market compared to international money managers. And we just have to ask ourselves who has more resources, and if the money managers are not allocating more into the benchmark Dow, then it is suggesting that perhaps this is not uniform enough. By and large, you can see that for the month, from almost from a double-digit loss, now we only lost only 1% compared to at the beginning of the month. So this is definitely an improvement. Still, it is down 1% for the month so far. We could actually end the month in positive because we have 28, 29, 28, 29, 3 days of trading into midweek before the month end in April. So there is a lot of time for this deficit to be actually be erased. And for all we know, April could actually end up marginally better compared to March. And that would be a major, major improvement. Okay. Then for the Nasdaq 100, Nasdaq has been the most robust. It has already turned positive. Okay. So Nasdaq is the only major equity index that has actually shows remarkable strength and resilience. So we can see that for the initial run-up, there was follow-through buying. After a brief pullback, now the index itself now is at the highest we have seen since this month begin. Okay, so this is definitely suggesting also retail. Now the Nasdaq is also a very retail-oriented index, although it is very tech heavy. We can see that there is very, very strong rebound in the tech sector. Okay, and we are going into the earnings season. This coming week, we're going to have the Magnificent Seven releasing their earnings. So if the earning is good, it will be a catalyst for the National 100 to perhaps even challenge the all-time high, which was actually registered on February the 19th at 22,222.61. So the Nasdaq right now looks to be leading the pack. Okay, so we will want to keep our eyes focused on the Nasdaq 100 because it suggests that it is even more optimistic compared to the S&P 500. Now, as far as gold is concerned, on Tuesday, I believe on Tuesday, gold prices hit all-time high. This is referring to the cash market. 3,500 is a very round number. The fact that the market hit this number and then start to pull back, it does not show up very much on the line chart itself, but in the candlestick, there is very clear evidence that we may be seeing the beginning of a correction. Okay, so 3,500 per ounce may be the temporary high going into March itself. Okay, so we do expect, or rather, I do expect a corrective pattern to unfold in the days and weeks ahead. Okay, now crude oil has also hit a bottom, $55.12 for the WTI. So this is wrong. This is supposed to be not sure what's the number here. But anyway, this is supposed to be April the 4th. Okay. So we can see that the low in crude oil has actually hit at $55.12. And we see a bit of a rebound. So this rebound is very tentative. It does not suggest a reversal in trend, which is basically just a technical bounce. So just understand that oil prices may have registered a temporary low at the beginning of the month. And it suggests that we may be either seeing a sideways markets for a while, or unless something happens in the Middle East that may cause oil prices to actually trade otherwise. Okay. So this is the dollar. The dollar has traded to 98.64, the lowest we have ever seen in 13 months. So we can see that the dollar continued to drop, but it does appear that the dollar index may have hit a bottom, very much like what we see in the oil market. And it's also at a point whereby, the equity market has stabilized. So that suggests that there is demand for dollar. Okay. So this could actually signify if the international money managers are reallocating capital back into the US markets, the dollar should actually strengthen because if in the early part of the month itself, we can see that the Wall Street has been coming under pressure. It is quite logical for international money managers to withdraw their funds from US. So now it looks like everything seems to have found a bottom and the dollar may be a reflection of this inflow back into the United States. So going forward, for those who are still short currency, be very, very careful because we are beginning to see evidence of a demand in dollar. Okay. So remember, tomorrow we have this election going on in Canada. Now, the current incumbent is McCartney, okay, who was the central bankers in Canada as well as the central banker in the UK. Now he is the incumbent. But I think the reason why he actually wants to have a election now is to secure a mandate to rule. The other person that is going to be highly popular is a Greek guy. I can't remember his name is Paul. Paul or something. Okay, I can't remember, I can't pronounce his name, but it's a Greek name. Okay, that guy is also very popular. And if Hani wants to get the mandate, he will have to defeat this guy. Okay, so that will be happening tomorrow. So maybe the result will start to roll in on Tuesday morning our time. Okay, so watch out this. And of course, for myself, my country is also going into an election. So that will be on Saturday, next Saturday. We are going to see a sea change because the current prime minister is untested. He took over the premiership from Lee Hsien Loong. And so this will be an exit test for him. Based on the rally that we have seen so far, it appears that the opposition is coming in very, very strong. So if there is going to be a change of government, it could possibly happen this time around. Okay, because I think the sentiment on the ground is not sweet because of this uh, cost of living issue. The cost of living issue has been a major bear hug because Singapore did not earn the title of being the most expensive city in the world for nothing. So definitely this will be a major campaign issue. So it does seems that people on the ground is registering their displeasure on the high cost of living. Will there be enough to cause a historic change in government? We do not know. Because if it does, then there will be a major sell-off in Singapore equity markets. Okay, because investors will flee. If there's going to be a change in governments or there is a marked increase in the what call that in the final result, I think currently the PAP, which is the ruling party, has about 60% mandate from the last election. If this number goes below 60, meaning to say if they only have a marginal case, even if they win, it is not a very strong win, it will still negatively impact Singapore equity markets. So for those who are holding Singapore equities, just be aware that there's an election coming up next Saturday. And if you do not want to be caught holding the ball, make sure you take protective action. Okay, I don't have to tell you what that means. Okay, so now uh, this will be coming up for the coming week itself, and it will be week number 18. We have a total of 52 weeks for 2025. So this will be week number 18. And these are the expected economic release. We have the Purchasing Managers Index. Oh, sorry. It's supposed to be the core personal consumption expenditure. I forgot to change the title here. But you can see it's the core personal consumption expenditure, which is a major inflation gauge. Okay, there is expectation for the month-over-month number, but nothing for the year-over-year, which is the more important number that we want to track. For the month-over-month, they expect this number to continue to come off very much in line with the CPI numbers. So if it's anywhere near 0.1, that's a good sign, okay? Because inflation on a month-over-month basis is coming down, okay? But again, we are very early in this game as far as the impact of inflation on the economy itself because of this tariff war that is currently undergoing. Okay, so for the year-over-year number, we do not want to see a number higher than 2.8. If it's going to be higher than 2.8, okay, you can see the market may sell off. Okay, so again, we have to watch this number. So we do not know what will be the final number. We have to watch this on Wednesday. And on the same day itself, we will be getting the first estimate for the Q1 GDP number. Now, the last quarter, 2.4%. Not sure whether this will be revised, but if it's revised downwards, it may impact sentiments. At any rate, Q1 of 2025, market expectation is the US economy has barely grown. Okay, 0.4% is definitely a bad number. Now, last week I gave you some kind of estimates from the New York branch of the Federal Reserve. That number is actually negative. Okay, so if it comes in at negative, there will be a knee-jerk reaction. Okay, meaning to say the equity market may come under heavy sell-off. Okay, so do watch out on Wednesday. Other than the core PCE numbers, the first quarter GDP first estimate is going to be also important to watch as far as sentiment is concerned. If it's a negative number, the knee-jerk reaction will be to sell off equity markets. Okay, however, if the number come in better than 0.4, for example, it may actually cause a bit of a bump up in prices as far as Wall Street is concerned. And the major number will be on Thursday, we have the other set of Purchasing Managers Index. Now, this is the index that most people follow, okay? But we'll only be seeing the manufacturing, okay? And we do expect this number to actually go from bad to worse. 49 is already in contraction zone, okay? And market expecting less than 48. So if this number come in anywhere near this number or even lower, then we can see a bit of a sell-off in equity markets. So do watch out. Wednesday, we have PCE numbers, we have GDP numbers, and on Thursday, we have the manufacturing PMI for the ISM. Okay, but the big one is on Friday itself, the non-farm payroll. Here, there was already some kind of consensus saying that unemployment is likely to stay stable at 4.2%, whereas the number of jobs being created is going to be less. And this will not be surprising because after Dodge came in to actually cut jobs in the federal government, we can see there's a lot of job losses. So the number of new jobs created could be even worse than 130,000 jobs in the private sector. Okay, so we will have to watch this number. Okay, my gut feeling is that it will be lower than this number. But again, we have to watch. If the unemployment rate surged beyond 4.2 to 4.2, that will represent the highest we have seen since the beginning of 2024. Currently, you can see that the last number was 4.2, which is the highest last year. So now we are matching the same high unemployment rate that we saw in 2024. Now, if this number come up to be 4.3, 4.4, you can see a very negative reaction in equity markets. Now, the hourly earnings, we do expect to see a dip. Okay, we can see that this number on the year-over-year basis has beginning to fall. Okay, so 3.8 was the last number, no estimate for this round. And if this number continues to slide, it means that US consumers are definitely not in a position to absorb the higher inflation that now we do expect. Okay, so this number will be very volatile, but the number to watch will be this year-over-year number for average hourly earnings. You can see that this curve is basically down. After a short bounce in July last year, the market has went plateau, and now the latest number for March was actually down. So I won't be surprised this April number will continue to slip further. Okay, so by and large, you can see that the economic climate is actually not conducive for a robust rebound in US economy. Okay, so you have to take that into consideration when you are taking on the markets. Right. Let me check if there's any new question. No new question. We'll go into the chart itself. Anybody here has any idea what you want to watch? Let me share the new chart. If there isn't, I will take the lead here and show you what to expect. Now, as far as the Dow is concerned, I say this month the Dow has been very muted. Okay, so we have 3 more trading days left to Wednesday before the month of April actually ends. So if this ends better than this, okay, and so far we saw a major sell-off followed by a very robust rebound. So this suggests that buyers could be in, suggesting that the 36,494 in the Dow could be a temporary low. But I do not expect this to immediately result in a challenge of all-time high. Not yet. I do believe that we are still in the corrective phase, which may last all the way to perhaps into the 3rd week of May itself. So anything after the 3rd week of May, I do believe the odds of another challenge of a high is actually quite probable. So far, I'm not seeing it. In the weekly time frame, you can see that the rebound here, okay, has not followed through. This was the low just before the 90 days pause, and this was the very, very strong rebound in the immediate aftermath of the 90-day pause. So we can see that the Dow has rebounded, but there was no follow through for the last 2 weeks. Okay, for the last 2 weeks, you can see there was no follow through buying, at least not visible in the Dow, suggesting that international money managers has not come back in a big way. Okay, they may have covered some position, but they are not coming in a big way. So this is the daily time frame. So because this is in this mode, there's a possibility of an extended rally going into this week itself. Okay, let me call this out. If there's going to be a 3 ways bounce, there is scope for an extended rally. Like I said, a 3-wave move is very common, and we do see that in all the time. So if we have a 3-wave rally, the market in the Dow could be targeting the 42,000 300 perhaps. Okay, at any rate, there is a high here at 42,859. So this could be one peak that the market may want to challenge. So going forward, in at least in the beginning part of the week, there could be an attempt to take this market higher, a follow-through buying, for example, because of the strength that we saw in the S&P 500 and the Nasdaq 100. So they may actually spill over into the Dow, which may eventually see extended rally. Okay, but I do not see this as a reversal in a sense. Okay, now when we look into the lower time frame, you can see that we have hit almost 100% in this three-way pullback. The ideal target was 37,725. The low was 37,843 before the market bounced. Okay, so here we can safely say that this rebound is this pullback is over, and the market is getting ready for a larger degree bounce from here to here. Let me put that in for you. On the low that we saw in September before the 90-day pause. So again, we are looking at 42,000, almost 300. So this will be the price to beat, 42,859. That will be the level to beat. If the market goes beyond here, at least in the lower time frame of 4 hours, the market will turn positive. Okay, so that may not happen immediately, but I think the odds of that happening is more likely to be in the Nasdaq, for example. So this is the Nasdaq chart, Nasdaq 100. We can see that the market, this is a very strong reversal pattern. Okay, if over the next 3 business days, the market continues to edge higher, this entire bar will turn into a classical reversal pattern. Okay, so do watch out. And this is on a month-to-month basis, very, very strong. The higher time frame, the reversal pattern is, the stronger the signal. Okay, so this happening on a monthly time frame is very, very rare. Okay, but it's also suggesting strength. The last time we saw something like this was over here, and that was in the month of August last year. That was followed by 5 months, 6 months of rally. Okay, so for all we know, if this month itself ends on a very positive note, higher than 19,441.5, it set the stage for a assault on the all-time high. So this is something that we have to watch. It's a very high possibility. Okay, in the weekly time frame, you can see that this market here has turned negative. So the level to watch this coming week will be the 20,350. Okay, here will be 20,349.6. But if the market trades above here, okay, then this entire market on the weekly time frame will turn positive, meaning to say that it has the dominant trend become bullish rather than currently what we are seeing as bearish. Okay, so there is a 3-wave pullback here. Okay, you can see here, first wave, second wave, third wave. So we can say that there's an ABC move here. So this is a very classic reversal, classic corrective pattern, suggesting that the low at 16,329.48 may be the low. Okay. And when we look into the lower time frame, now this is the 3-wave I mentioned, the 3-wave. Okay. So you can see that there is a breakout here on Thursday. There was a breakout on Wednesday, but the market did not close above this resistance line. But on Thursday, it punched right through and stayed above. Friday continued to extend higher. So there is evidence here that perhaps the buying interest in the Nasdaq is a lot stronger. So watch out for the Nasdaq to take the lead, to take out the high here at 20,349.6. Yeah. Watch this number. And in the daily time, in the 4 hours, okay, all the market need to do is to take out a nearby high and 19,879 and a quarter. That will be enough, okay, for the market to erase these pink color boxes and only keep the green boxes. Okay, now this 3-wave pullback has already ended almost to the T. Okay, this is an equality move, 3-wave move that is over. So I erase that, keeping only this larger degree move. So if there's going to be a change in sentiment in US equity market, I think it will first come in the Nasdaq. And in the S&P 500, the same thing. S&P 500, if you're going to look at a monthly time frame, this is not as strong as a Nasdaq, but it can still be a positive because we still have 3 more trading days left before the end of the month. So if the market actually close way above the opening, which is at 5,601, okay, if the market on the end of the month on 30th close above 5,601, that will actually cause this index here, this bar here to turn positive and in a very, very strong reversal pattern on the monthly time frame. Very, very significant. And in the weekly time frame, you can see that there is follow through from the week before. Here we have also a three-wave pullback, slightly beyond equality, followed by a strong rebound. So this three-wave suggests that what we have seen so far is a classic three-wave pullback, nothing more than that. Okay? So unlike the Nasdaq, we only take very little to actually change the overall dominant trend. Here over here, you can see that S&P 500 would have to take out this 5,791 before it turned positive. Not impossible, because currently we are at 5,524. Okay, all it needs is maybe another 300 points and take out this high here, and the whole entire structure on a daily time frame will turn positive. Now, in the lower time frame, we have not turned positive yet. In fact, I was thinking that perhaps there is a possibility of a near-term pullback. If the market pulls back into this bracket of prices, okay, which is the 50% to 61% pullback of this entire range from 5,001 to 5,533, this bracket will actually be quite conducive, okay, to reposition long. If you have not already gone long, then for those who are interested to play the upside of this market, this could be one area to look out for, and the target will be here. Okay, I don't see an immediate runaway, but if the market can trade into this level, all the pink color boxes will be eliminated, keeping only the green boxes. Okay, here we should have a good 500, no, at least 400 plus points here. Okay, could be something quite doable. But before the market go higher, I do expect a little bit of a pullback, ideally in a three-way structure into this bracket of prices at 5,267 to 5,318. That will be a great level, technically speaking, to reposition long. Okay, right. Now I have finished the equity markets. Let me see if there's any question on your side here. No new question. All right, I will continue with the European markets. Let's take a look at the DAX. Now the DAX closed very, very strong. Okay, surprisingly, the index here that show more bullish sentiment appears to be in Europe. Here it is the German index. You can see that this is a classical reversal pattern. I think with only 3 more days of trading left for the month of April, it is very likely we're going to see an improvement on the 22,362.45 that we saw this past week. Okay, so the breakout could actually happen in Europe first. Okay, the European market appears to be more bullish than Wall Street. Okay, this is based on the monthly time frame. In the weekly time frame, you can see of this past week, we have seen a very positive close. In fact, the week itself closed at the highest level, 22,362.45. Very, very strong. It doesn't take a lot, okay, for the market to breach this all-time high at 23,489.70. Okay, so everything looks good for Europe as far as the Germany, the German index is concerned. Okay, especially if the market do take out this low here. This low here is at what? This low here is at 22,420.2, because that will mean an overlap. We are not that far away because the closing price on Friday was 22,362.45. So if the market goes a little bit higher and overlap with the low here, it eliminates the risk of a 5-way down, okay? Because the 4th wave cannot overlap in the wave 1, okay? So that will be classical Elliott wave rules. Because if we do not, if we have a extended rally above 22,420.2, okay, it will eliminate the risk of the market turning back down into a 5-wave. Okay, right now we are almost at the extreme barrier. Okay, for the 4 hours time frame, all the market need to do is to take out 22,593.3 to turn the whole market very positive. So going into the week itself, I think Europe is going to do better. Can we see that in the FTSE, for example? In the monthly time frame, the FTSE is also very, very strong. Now, this is also a classical reversal in a sense, although ideally the color is we have a closing higher than the opening. Okay, the opening for the month itself was at 8,610.19. So currently the market closed at 8,448.65. If we can close a little bit higher, okay, which is not totally impossible, then we could get a very positive closing, setting the stage for a resumption of the assault into all-time high, even for the FTSE 100. So there are two major equity index here that shows very positive, very likelihood of a resumption of the bull market. So do watch out. Here we have seen the weekly time frame, very, very strong rebound, 3 weeks in a row. Okay, from the low here, 7,531. And this actually put it in a very, very strong position to take out the immediate high here in a weekly time frame at 8,744.47. Daily time frame, same thing, very, very strong. Okay, although the momentum has lost a little bit over the last 3 trading days. Okay, Tuesday was a very strong rally. Then on the lower time frame, as you can see, the market has more or less quiet down. Okay, do expect a little bit of a pullback before the market resume, perhaps on Wednesday. Here over in the Asia, we look at Nikkei 225. The Nikkei 225 is also in a very strong position to follow through. You can see that this is a classic also reversal pattern. Now the low here is only marginally lower than the previous low here, okay, at 30,797. The low here is 30,357. This is a very remarkable recovery, setting the stage for higher prices. Now remember, the Nikkei had big trouble getting beyond 40,000, so that will still remains a barrier to higher prices. 40,000 is going to be a big barrier. Okay, currently where it's now, it's just under 36,000. Weekly time frame, you can see 3 weeks of rebound, very, very strong. Okay, although not as strong as what we saw here. Okay, but still, we see there was a fake move here. The market took out this low here marginally before it reversed direction. So a lot of people who put stops here to sell, okay, or who have previously bought and put stop loss here, have all been taken out. And this is what we call the hunt for liquidity, and the market is getting ready to trade higher. Daily time frame also appears to be quite strong, but there is an immediate barrier here represented by the resistance line here. So immediate barrier to higher prices will be 37,000 thereabout. If the market can close above this red line here, that will be the first inkling that there is a very high possibility the market will go beyond 38,231, which will eliminate all the daily buyers to the downside and put the market here in the Nikkei for higher prices. Same thing, okay? Market has finished that three wave. Okay, this three wave is not impulsive except for the initial bit here. Okay, so take your cue from the European market. Hong Kong, let's take a look at Hong Kong. Okay, Hong Kong has not been particularly strong. That is understandable because of the trade war. So unless there is improvement in the trade war between US and China, it is very difficult for the Chinese equities and by extension the Hong Kong equity markets to trade higher. Okay, so this will remain under a dark cloud. Not sure whether there will be any improvement in the trade war between the United States and China. If there is, okay, then that could cause this market to rally. But it is right now for the month itself, for April, if this month can close on a positive note, meaning to say that it closed above the opening price at 23,156, that will be very, very positive. Okay. And the weekly time frame, you can see that this is a classical reversible pattern 3 weeks ago. And it is very interesting to note that this week's high actually covers this gap. Remember, 3 weeks ago, there was a gap down in the Hang Seng. And this week, the market actually more or less covered up this gap that it was that was left gapping. Okay, you can see this clearer in the daily time frame. Over the daily time frame, you can see this gap, very big gap here. Okay, and it has been effectively being covered by the rally on Wednesday. Although it did not quite completely cover the gap, but it is as good as it comes. Okay, so going forward, the objective of covering this gap here has been reached more or less, unless there is new catalyst, the market may actually be hovering around here, perhaps even coming back down. Okay. there is possibility the market has gone into a very deep retracement. Okay, uh, as you can see, the prices here are not definitely suggesting that there is further push higher. In fact, this bar here has a reversal pattern on the lower time frame, so that could actually entice people to take profit from this recent bounce here from 19,000 all the way to 23,000, almost 400. All right, I finished with the equity markets. I still see that there's no new question. I will continue and take on the currency market. Here, I want to show you the dollar index. Now, the dollar index on the weekly time frame has been very, very strong. We have a three-wave pullback, not quite exactly to equality because the ideal level will be a 94.47. Okay, but here I did remember last week I put this to remind myself that the downside risk is getting lower. In fact, I have been starting to look at the positive side of the dollar itself, and going into the third week of May, okay, this thing could actually lingers for the next 3 weeks before it starts to show sign of buying interest. Okay, so that could either signify something bad happening elsewhere, because if the dollar has to rally, it means there must be demand for dollar. Okay, and that could come from possibly two direction. One is an improvement in the trade war between the US and China. That means investors are coming back to the US equity markets. And by the extension, they need to buy dollar first before they can buy US assets. The other one is, of course, geopolitics, uh, an escalation in geopolitics resulting in capital flow into the United States. That will mean that uh, if there is going to be an escalation in, let's say, the war in Europe or the war in the Middle East, or even the war between Pakistan and India, you can see capital will instinctively move towards the dollar. That will create a demand that may cause the dollar index to bounce. Okay, so over the next 3 weeks, do look out for not only the economics, also look at the geopolitics. This could be the catalyst. Now, when we look into the, what did I show here? This is the daily time frame. The low is at 97.67, okay? And this is the daily time frame. This is the Tuesday low, okay? Market since has rebounded and it may continue to bounce. Once it clear above the 100, it will give it the strength to actually to continue to test higher ground. But here we can see that there is a downward slope in the resistance line. So it will take a lot for the dollar to be able to breach beyond this resistance line. Okay, I do not expect the dollar to stage a surge just yet. I think it will be more or less sideways with a little bit bias to the upside, okay, as people start to cover their short position. Okay, so do watch out for that. This is the 4 hours. 4 hours, I do see a bit of a bounce, but I think there could be a minor three-way pullback. If it's going to be a minor three-way, anywhere between 98.5 to 98.7, this small little bracket signified by a 50% pullback may be the last call before the markets starts to stage a surge to challenge the 100 levels, okay? Creating a larger degree three-way. Okay, but this is the 4 hours time frame. So near term, I do expect a little bit of a pullback, ideally in a three-way pullback into this bracket of prices between 98.55 to 98.7 even. Okay, so that set the stage for the other currencies. So if I do expect a little bit pullback in the dollar index, that means to say that there is scope for perhaps another bounce in the currencies. Here we have the euro dollar. Euro dollar has been trying to unfold as a three-way. So it has not yet hit its target. This month itself, the highest traded was 1.1573. Okay, the ideal equality here will be a 1.19 even. Okay, that means there is scope for more than 100 pips. So if you see a bit of a move up here, the overall trend in the euro dollar remains very negative. Okay, so the larger dominant trend in the monthly time frame suggests that the euro dollar is still very much in a bullish, in a bearish phase. So this bounce that we see from 95 cents all the way to $1.19 could be the three-way bounce. After that, there is the possibility of a continuation of this bear market in the euro. And this will be universal for the other currency pair. So you can see this larger degree three wave. If it continues higher, we are looking at 119. Okay, so a bit of pullback followed by another surge towards 119 is a very real possibilities. Here in the day time frame, we are beginning to see a counter trend in place. So there is a possibility of continuation. Lower time frame, I think a three wave, if it can bounce back to let's say 114, we may see another drop towards a 111.55 to 111.75. So this could be the last area to buy if I still going to maintain the near-term bullish outlook for the euro. Okay. Sterling. Sterling long-term is also unfolding as perhaps a not so neat-looking three wave. If this is going to be a three wave, there's a call for the market to eventually go beyond this level here. Now, this too high here has been the barrier to higher prices. 143.70 to 142.60. Okay, this about 100 pip range has been capping the market. So if this is going to be a three wave, the target is at 148. Now remember, this is a bounce within a very bearish market in the monthly time frame. So higher to sell, but watch out. Do not sell too early. Wait for the market to see whether it can have enough momentum to take out this too high here. This will be where the buy stops will be accumulating. Okay, especially 143.75. Once the market break this level, we want to see whether it can sustain beyond this level or it end up coming back down. Okay, so for those who want to go long, look out for a break of this level first. Hopefully, there's enough momentum to target 148, but it is a bounce within a bear market. This is the weekly time frame. Market is basically sideways in a very broad sideways between 118 to 134. Okay, very, very broad sideways pattern, but it is currently suggesting that there is that rebound that we may see following through. Okay, again, this rebound is within the context of a bear market. This is the daily time frame. We have more or less a five-wave rally. If there's going to be a pullback, it's going to be a corrective pullback followed by maybe another set of five-wave towards towards the higher target here, okay, which is 148. So in the meantime, very much like the euro dollar, I do expect a little bit of pullback, ideally into 130 to 131 levels. If we see a pullback into this bracket of prices, that could be the last call with a very low risk trade setup. Okay, if you put a stop just below 130.30, okay, that could be the maximum risk, and that will be a very attractive level to go in to do this for the continuation of this rebound in the sterling. Let's take a look at the Japanese yen. Japanese yen remained three wave from the pullback of 162. Okay, this low that we saw this month has not even taken out the previous low at 139.58. Okay, the lowest we have seen so far for this month, 139.88. Okay, so there is possibility we should see a continuation towards at least the 130, 136.80. Okay, that will be a classical three-wave equality move, or anywhere between 131.60 to 136.80. Okay, anywhere between these two bracket of prices, I think we should be able to see a intermediate low before the market attempt higher. Do understand that the dollar remains very strong against the yen. Huh? Now, this is the weekly time frame. In this case here, we can see the three-wave clearer. There's still the possibility the market will extend lower into 136.5. This will be the equality of this move from 162 to 139.58, back to 158.90 before the continuation to at least test the 136.5. If the market goes deeper to 131, that would be a bonus, because that would be a great level to actually reposition long-term long position with risking no lower than 126.35. That would be a great setup if it ever comes. So you got to see how the market unfolds in the near term. Dollar remains very much bullish. So in the lower time frame, like the 4 hours, I'm hoping that we can see a pullback, 50% of the rise from 139.90 to 144. So if we do have a pullback into this bracket of prices, that could be a short-term play to go long at 141 half to 140, 140, 142. Okay, risking no more than the low here you see at 139 90. Okay, that's my outlook for dollar yen. What about dollar Swiss? Dollar Swiss has actually been benefiting, or how should I frame it? It should be the Swiss franc has actually benefited because of the run to safety. Okay, while the dollar was coming off, there was a very obvious move into the Swiss francs, resulting in the dollar Swiss franc pulling back. Now this week is this past month you can see the low at 80 cents to the Swiss franc. Okay, so that may actually be ending soon if we take a look at the dollar index. This week itself, we can see that there was a rebound, not very, very, very strong, okay, but at least the low here at 0.8040 may be the temporary low, okay. Now, if you look at this from the compress, if I compress this chart, you can find that this is actually the very deep retracement, okay, anywhere between 75.70 to 81 even. This is the area to look for buying position. So now here we see that the market has actually rebound off on the weekly time frame. It's no surprise. On the daily time frame, you can see that the last this week itself has been very positive. After the low here, we can see the market has been trying to rebound. So there is evidence that there's a bit of a short covering going on. This is the 4 hours time frame. If we see a minor pullback, maybe to challenge the low here at 82, 0.82, I think that's about all we can see. Perhaps the market will extend higher towards the 0.84 half. Dollar, let me take a look at the Aussie. So we can see that they are all starting to reverse. They are all very much in sync with the dollar index. If the dollar index seems to have found a bottom, then you can see that the other currencies should also react correspondingly. Okay, so this is the monthly time frame for the Aussie. The Aussie low this round is at 58 cents, 59 cents. 58 cents is just marginally, it actually dipped into this very deep retracement on the monthly time frame very briefly before it started the rebound. And this so far looks very positive. Okay, it should see at least a temporary bounce towards a most recent high at 0.69 half. Swiss weekly time frame, okay, there is the bounce that is still continuing. So the near term high is this level, okay, 69 half, 0.69 half. So that will be a good area to challenge. Daily time frame, we can see that the surge has been very strong and there is only green color, meaning to say that in the daily time frame, the Aussie has turned positive. So if you're going to do something short term for the Aussie, perhaps the opportunity is on the buy side. And if that's the case, if the market can pull back as deep as 61 and a half, that could be one good level to go in because that will represent 50% of the pullback from the low here at 59 cents all the way to 64 and a half. All right. So it may be a little bit far-fetched right now, but you never know, right? So far, the market is consolidating, looking at the fact that the there is not much of selling, but there's a lot of evidence of very strong buying interest. Now we look at the Kiwi, for example. The Kiwi should reflect something very similar. Now, Kiwi is on the relative basis stronger than the Aussie. The low here did not take out this low, and that is already sign of a relative strength in the Kiwi. If you have to go long, either the Kiwi or the Aussie, the Kiwi seems to offer technically a better outlook. Okay, the low here is 0.5484. Okay, and this is marginally higher than this low over here. So that put it in a very good state. On the weekly time frame, you can see that the strong rebound here is actually quite encouraging. Oh, I have to remove this one because the low has been taken up. Okay, starting from here, this could be a start of a new trend. On the daily, you can see daily is very, very strong. If we do get a 50% pullback, that will be a bonus. 50% mark will be at 0.577 60 thereabout. Okay, this level. If the market can pull back, that may be a good level to consider. Okay, but of course, we're going to look for Q in a lower time frame. That means that the market would have to go down a lot lower than what we are seeing. Okay, 57.60 thereabout. This will be a good level. Okay, all right. I finished the currencies. Let's take a look at what's on everybody's mind, which is gold market. Gold has a magnificent run. Okay, going into this week itself, there were uh, last Sunday I was talking about a temporary high in gold this week, and it did happen. 3,500 is actually a very round and nice number. Okay, in the spot market on this platform, IronFX, the high was just 1 cent, 0.1 cent, uh, zero point zero 0.01 cent. Okay, to the 3,500. Very, very nice number. It missed the target by just a bare $16.50. Okay, but you can see that this is an extended run. Now, this high here has already exceeded the 1.618, okay, which is a typical third wave kind of sentiments. So this bull market is by no means over. If we do get a pullback, it will be a fourth wave pullback, assuming this is the third wave. Okay, so here, remember, I put this to remind myself that we may actually see a top at around 3,005. So this one has already happened. So I don't have to remind myself this anymore. And this should be followed by a 2 weeks pullback going into the first week, uh, the second week of May. So over the next 2 weeks or so, okay, we should see some sort of consolidation with a little bit bias to the downside. Okay, so that is setting the stage. Overall, the market remains very, very bullish. Huh? So this may be the opportunity that we've been waiting for the market to come back. Here, there's a common level here. Okay, here, 2,555. You can see there's a acting as a resistance and a support here. So $2,955 could be a near-term support. Okay, if you ever come into this bracket of prices into this level here, watch out for reversal to the upside again. Okay, here we may be seeing what appears to be the making of a potential three wave. It is not fully in place yet, but it could actually unfold as a three wave. Perhaps you can see that in a lower time frame. Okay, here the market attempts to rally on Friday. So if this could be part of the wave A, and what we are seeing here could be the making of internal three wave, and this bracket at $3,380 to $3,400. For those who have not taken profit on their buy side, this could be the last bounce before the market complete this three wave into 3,193 to 3,259. Okay, so that will complete at the bare minimum a three wave pullback. But before the market do trade lower, I suspect that there is possibility the market may bounce higher into this bracket of prices, 3,380 to 3,410 thereabout, before it completes this and come back down to test the lower end. All right. Okay, this is my outlook for gold. Silver has been the laggard. Okay, silver appears to be also unfolding a three wave, but not quite to the equality level of $36 per ounce. Perhaps it can do that. Okay, as gold prices pull back, we can see that the pullback in silver is not as deep. So that could be a pivot into silver in the coming days and weeks, at least for the next 2 weeks. So there's a possibility that silver may continue to trade higher. Okay, silver has completed a three-wave equality move pullback followed by a bounce. So if this bounce result in a closing above $34.86, it put the stage for the silver market to actually try to go for $36 over here on a monthly. Okay. The price to bid on the daily basis will be $34.57. Not too difficult. I think you can do it. So there's a possibility of a pivot into silver as profit taking occurs in the gold market here. Right. What about oil? Oil market do not seems to have found a bottom yet because a three-way pullback suggesting that we may see $35 or $36 at the bare minimum. But the market has found a temporary bottom at $54.76 this month. Okay. So whether that will amount to a really solid bottom remains to be seen. Okay. Here we do not have very solid evidence just yet, but what it does tell us that this low here could be a temporary bottom. $94, $54.76. Here is the daily time frame, not a very strong rebound just yet. It could always slide back again. Okay, so maybe what we're going to do is just watch and monitor the oil market without taking up any positions. There's no strong evidence that this thing will hold. So if you're going to be short-term trading, this level could be offering a good area to position long. Okay, again, this will be a 50% pullback at $59.71 to as low as $58.55. Short-term play, if this is going to be like this, pull back into this bracket, especially with a three-way pullback into this bracket of prices, it offers a buying opportunity for a continued rally into $66.38, which will complete the symmetrical ABC move. Okay, we are into the last stretch in which I'll be talking about the crypto. This week itself, we see Bitcoin coming back alive. Okay, from a low of $74, 74,500, we can see that Bitcoin has already traded back to 94,000, which is a big a big improvement here. This suggests that there's a possibility the month of April could see a rebound in the Bitcoin prices. By extension, it will also be the catalyst to also cause a corresponding rise in the other altcoins. Okay, this is a weekly time frame. So far, we have a three-wave pullback, slightly deeper than equality, and the market now is rallying. Okay, the price to beat will be 99,500. If the market can actually trade and close above 99,500, it will set the stage for an assault on an all-time high. Okay, technically speaking. So the three-way you can see over here, A, B, C, followed by a bounce. This bounce has been very, very strong this past week. This is the daily time frame. The market has already broken out of this resistance line that we saw since January of this year. Very, very strong breakout, and it may stay elevated. So there is very little pullback so far over the weekend. Perhaps you can see a bit of pullback, maybe not much lower than 91,000. Okay, so that could be the area to watch out for. Okay, seems that there's one additional question. Natural gas. Okay. I have not watched natural gas for quite some time. Actually, I haven't been involved in natural gas for quite some time already. I've been trying to find a bottom, but never quite succeed. So we can see that there was a major run up in prices to $4 and almost 90 cents before we see this month selling back down to test the $3.20. So it is still very slippery, although there is already evidence of a counter trend rally. Okay, the dominant market is still very, very bearish. Okay, from almost $10 down to $1.58. So in the weekly time frame, this is the fourth week in a row that natural gas has closed weak. But as the price goes down, especially into $2.56 onwards, it starts to look attractive. Okay, anywhere between $1 and 92 cents to $2.56. This could be a good area to consider scaling in. Okay, putting your stock at the bare minimum just below $1.92. If you're more aggressive, you should put it below here at $1.58. By and large, it does look good, okay, that this level may actually hold $1.92. So if the price slides further in the coming week or so, okay, into $1.92 to $2.56, that could present a buying opportunity. So far, we have a three-wave pullback, very neat, hit equality, and then a little bit more, and bounce. Okay, so this three-wave pullback could suggest that uh, there could be tentative buying interest. Okay, 4 hours time frame suggests that we are in a very good position to be buying. So if I compress this chart here, the price is very deep in a 4 hours time frame pullback. This is a very deep retracement, even lower than almost hitting the 100% pullback. So this three wave is actually very ideal for buying. On the lower time frame, 4 hours time frame perspective, putting the stock no lower, marginally lower than $2.99. Very, very good, very, very good risk reward. Even if the market rebound back to test the higher at $3.89, it is at least 1, 2, 3, 4. At least visually speaking, 1:4 risk reward ratio. Okay. Would still be a good buy if the market slide back? I think it is. Okay. If the market does slide back into this bracket of pricing, maybe it is worth a look because we have a three-wave pullback and into a very deep retracement levels, suggesting that technically speaking, the risk reward is superior here. For risking very little, I think there's a scope for the market to go back and test the $3.70. All right, I have finished all that I want to share with you for this week. Anything else before we close the session? If there isn't, okay, I will. Oh, there's one more. Let me see what's the last comment here. Oh, thank you very much, Jim. All right, thank you very much. I'll see you next Sunday. Bye bye.